Thank you for joining us this afternoon on this panel about new venture ecosystems. My name is Luca Zorzino. I'm a partner at Illuminate Financial. We're an early stage investor in B2B and enterprise financial technology globally, backed by some of the largest financial institutions, including JP Morgan, Citi, Barclays, and other. I'm joined on the stage here today by Sharif El-badawi. He is the CEO of Dubai Future District Fund. Please help me welcome Sharif, as well as Monica Brand Engel, who's a co-founder and managing partner at Quona Capital, and finally Luis Valdich, who's a managing director at Citi Ventures. We have quite an international panel here today, representing a lot of different ecosystems that have been impacted quite differently by the changing environment. Right? We heard earlier today by Piyush Gupta at DBS around how the macro environment has changed over the last 12 months, and we just heard about how ecosystems are developing around the region between financial institutions, regulators, and us, the venture community. So I thought we'd kick off with Sharif and kind of hearing more about how the ecosystem and what you are focused on and what kind of excites you about the venture community here in the UAE.
Thanks, Luca. Well, I've been investing in the region, coming from the US, investing in the region for the past 7 or 8 years. And it's changed a lot over this time. I think the pre-COVID era was really nascent, and we didn't have a lot of VCs or VC activity, but that's changed quite a bit. And the number of exits on the other side of the spectrum has increased in size and frequency over the last few years. We're focused right now on adding additional capital for VCs in the market and also for direct investments into startups. And we do that we're trying to be thoughtful about doing that in areas that are pushing the envelope on technology, where it hasn't been the case in the past, where most of the businesses that are being formed here are what we call business model clones. And they're hitting the obvious, lightweight sectors, maybe surface of technology. But the fund is gearing up to start to back deeper technologies in the region.
Fantastic. Monica, your focus is on emerging markets. How has that ecosystem changed over the last 12 to 18 months?
It's been a phenomenally exciting time. I think both COVID started the real relevance of digitization as we were forced to do things remotely and really helped accelerate adoption. And I think we see that across our markets. In addition, with the recent macro crisis, I think what's been really exciting is to see how resilient some of our markets have been. Emerging markets have been challenged as capital has really been withdrawn, especially from the West. And what's really exciting is to see local capital markets develop and actually a flight to quality. So people being very discriminating and seeing in terms of value, especially the phenomenal values in terms of core KPIs and really incredible talent building innovations that solve real problems. And I think that's true in emerging markets almost more than the West.
And Luis as well, from the Citi viewpoint of kind of global markets. What has been your experience?
From Citi Ventures, I guess to contrast, right? Because it's interesting how we're situated from UAE to broader emerging markets to more global investors. At Citi Ventures, we invest across the US being the main market, but across the Americas, but also in Europe, Israel, and also in Asia. We have been observing a very dramatic change. You asked about 12 to 18 months, and to me, I would almost want to split that and talk about the past probably 9 months, since I think the last quarter of last year's when the deceleration in private markets became more blatant. In public markets, I'd say it was more in the middle of the year when you started to see the adjustment. It even started in the second quarter of last year, but there was exuberance until then. Almost like they talk about the many years of fat cows and then of thin cows, and we are, I think, still going through that adjustment phase. In some markets, it's been more dramatic than others. I think Latin America, I'm originally from Bolivia, and we do invest in Latin America as well, although not a primary focus. The previous year, I think, was close to Europe in terms of the overall level of fintech funding. And then if you look at that math for last year in relative terms, there's a massive gap again, right? So there's been tremendous, variation across the board, but I think nobody has been spared. I think that across the system, we are still facing significant adjustments, and yet, by longer-term historical standards, I started investing with SoftBank back in 2000, very different than the Vision Fund. The level of venture and tech investing activity is just so much higher than it's been, and I assume all of us have seen that wild ride. That I think it's still very exciting times, despite the different environment that we've been having of late.
There's definitely been some very interesting juxtapositions across markets. So if you look at the overall venture funding activity between Q1 2023 and Q1 2022, globally that's dropped 90%, right, by value. Interestingly, by volume and number of deals, it's actually remained relatively steady. So, there's still a lot of resilience in a lot of these systems. And then there's also been a lot of differences in stage, where, especially at the later stage, B, C onwards, very big drop-offs in valuations. While actually in the seed stage, we're actually seeing still increased rounds and round sizes. And I think that also translates to different geographies as well, right? Like we're seeing Asia being more resilient. I expect this region here, I don't really focus it on that much. Maybe might be helpful to kind of dig into that a little bit and think about how is the resiliency and the excitement in this region kind of kept on going outside of the maybe global order.
I mean, so let's say 2017 timeframe, when I started looking at deals here, there were about 4 VCs in the region, and now we're clocking about 200 VCs per year. And importantly, I think the percentage of those VCs that are coming from outside the region, investing in the region, has increased to about 30-35% from maybe 15-20% originally. So those are all good signs. Now, the types of startups here are used to going through hardship. So they didn't have a lot of infrastructure, funding sources, knowledge, or anything like that. So they're just slightly more resilient to start with. It's kind of like 30 years ago in Silicon Valley, where you used to build something and then try to get funding for it. Now, that's obviously changed over the years. But the other thing that I think is a marked difference is that startups here are not used to being on the VC IV so quickly with valuations that are too far ahead of their traction. So to correct for it is a little bit easier. Now, we went through the 2020 to 2022 bubble as well, so we did have a lot of overpriced companies at some point. That correction has yet to be seen in the way that you've described the rest of the world. I think partially because we have a very motivated set of governments here that are pushing entrepreneurship pretty hard, thankfully, and there is plenty of capital. So VCs are loaded, the LPs are loaded, but we are being conscious about correction and how it's going to affect the region. The macros are important, and they do affect every country in different ways. But luckily, the earlier stages, you were distinguishing between late stage and early stage funding. The crashing always starts at the top, and the delta is always bigger. The bigger the giant, the bigger the fall, right? So you stated a point about volume decreasing and number of companies increasing, and that points to earlier stage getting more funding. So the volume of deals is high, but the amount of capital is low. It's the very opposite of the statement I would have been sitting on a stage maybe 3-4 years ago, where we started to say the opposite, where we said the number of deals is shrinking, but the overall capital is increasing, right? Because too much money was going to too few deals back then. So now it's flipped back to what I would call normal. You're supposed to have a very big base and fewer make it and matriculate to later rounds, and that's what we're starting to see. And the last point I would make is that everyone asks us how MENA is doing with regard to the global downturn. And honestly, we just have not seen as dramatic of a fall yet. And I say yet because it's a bit masked by the dry powder in the region. We had GPs that were flush with capital funding their companies, and those companies have managed to maintain a decent runway until now. Cost cutting and everything, just like everyone else has done, but the runways are being able to stretch because cost bases are slightly lower here. So it's one of the arbitrages that we have advantage to. There's that, and then the later stage companies that, let's say, their traction is not aligned to their valuation are kind of afraid to come to market. So we have noticed a slowdown of approaches from startups coming to funds.
Yep.
They just in the last 6 months have not been fundraising. And so some of them have the runway to stick it out. Others are trying to do cost cutting to extend their runways. But we do think the reckoning is going to eventually hit us here. And I think that'll happen towards the end of the year.
Yeah. And Monica, we were just discussing about your experiences in Africa and your investments there. Keen to hear more about how the ecosystem is developing in that part of the world.
Yeah, I think Sharif made a couple of good points that I'll just echo and maybe contrast a bit, because there is, I think, nuance in each of our markets. So I do think we're in the middle of this, and actually Louis, you said the same thing, probably 9 months to 6 to 9 months, we're feeling it, I think, more intensely, especially in emerging markets. I totally agree, Sharif. It's felt most acutely at the Series B and C, the later follow-on rounds, where people are really, the pockets are closed. For many of the European investors or the later stage growth capital, that is just thinner in our emerging markets compared to the seed stage or early stage. So, and I would lastly say that Africa, sub-Saharan Africa, is feeling it more than Northern Africa or certainly GCC. And those markets are, don't have, as I think, forward-thinking a regulatory system as they've developed here in the GCC. There's been a real investment, and it's very evident as an investor how inviting this ecosystem is from an investment point of view, and it's really having that virtuous circle. And I actually just shared data from this morning. Egypt has just overtaken South Africa for the last 6 months in terms of the number of deals, the VC deals that are getting closed. So interestingly, it's Egypt first, then South Africa, then Kenya, then Nigeria. Nigeria was the lead 2 years ago, and I just think, again, it speaks to, I think that's mostly, there's phenomenal companies in Nigeria, but it really speaks to an enabling environment, a regulatory appetite to, in a calibrated way, take risk. And I really think it shows in terms of the ecosystem. The last thing I'll say, and I think it's another benefit of the GCC, there's local capital. So we love, like Brazil is another market that's a very successful market for us. And one of the reasons for its success is that there's a lot of local capital there. It just makes you less dependent and less affected when there's macro shocks. So it really is a benefit of this region that creates a sustainability and a predictability that, as an investor, again, we love.
Louis, you've had a front row seat, right, being based in New York, with all of the giants of fintech that have been around for the last few years, around Robinhood and the others that have obviously kind of suffered quite heavily in terms of valuations. What is the mood on the ground at the moment, and do you have any expectations around when the funding environment might recover a bit in the US?
Yeah, I'd say that there is clearly a very mixed mood depending on investor types, and generalizing, I'd say that the observations are that in terms of the capital allocators, what I'm hearing is that fundraising in the US is becoming really hard. So there's been a tremendous flight to quality, and increasingly funds are looking elsewhere despite the very deep markets there. There have been some of the premier funds announced closings of late, but a very different dynamic, and a lot of those processes had started earlier. On the direct investing side, there were a number of over funds, many of which were hedge funds that started to dabble and then started to invest much more actively in venture capital, and that's being a very marked dynamic, and we've seen it in many portfolio companies where there's been a need for follow-on rounds and they just haven't been able to participate, and as they had come in before with very large checks and were disproportionate owners, in some cases it causes a very tricky dynamic. Some of those are just completely out, and even on punitive rounds, pay-to-play type rounds, they just have not invested, which is pretty remarkable. but understandable because their public holdings have been so crushed that the capital allocation becomes really hard. In other cases, they've shifted to very early, which explains in some regard why the dichotomy that you were observing earlier is been going on. So the overall funding environment has changed very dramatically. You now have in some ways it's going back to normality. You now can do diligence. Before you had to move so quickly because the rounds would get done, and just getting a few weeks of an extension meant that the entrepreneur really wanted you in the round because they could easily close without you, right? So all that is clearly changing, but the markets are still open. Rounds are still getting done, even though lots of down rounds or rounds with the structure are happening. And everyone talks about how there's massive overhang and that things will be totally fine, etc. But I'm not sure whether we're done and that things will start to rebound. I could easily see the overall level of funding continue to decline a bit. Again, it's at historical highs, right? If you exclude the past 3 years of continued exuberance. And my hypothesis is that even if you have a large fund, your LPs might actually not want you to do full capital calls. And as you're going to be raising again, you probably need to be very thoughtful in terms of how much of that capital you call, because everyone is being suffering of the impact on their own public holdings that then they need to adjust if capital calls happen. So I think it's a very complex dynamic, but on the positive side, there's so many exciting opportunities coming up, so many great entrepreneurs, so many strong fundamentals, for continuing this very exciting digitization, journey that we're all embarked in, that I am still very much long-term bullish, but we're still, I think, in the middle of an adjustment period.
I think about that, availability of capital versus, availability of opportunities to deploy in quite a lot. And one of the things that we've been talking a lot about in the venture circles is, potentially a mismatch of expectations between investors and the entrepreneurs that are raising. Is that something that you've experienced more so this year?
Absolutely. I would just say, I smile a little bit. I mean, I do think, investors, because we come to places like Dubai and New York, and we actually see and hear predicted, especially you saw the public markets, you mentioned, Luis, that we had harbingers of what was going to happen. But when you're an entrepreneur, your head's down in your market. And so just to even say that the party's over, that those exuberant valuations, and even to explain like zero interest rates, like, I am old enough to remember when, interest rates were double digits, and this notion that was such, that we will probably, my kids will probably never see that again. And really to have it sink in, that this is not just a curve that's going to return, where this is normal, so this is normal. And so I do think, and I think also the nature of an entrepreneur is to think optimistically, glass half full, to sort of take every no as like just another challenge. And so it's been a struggle to have our entrepreneurs realize that this is a reality. And I will say we have some investors, because it's not just a philosophy, it's dilution, right? So it's your economic value, the thing you're building, you now own less of as valuations come down. So we are, as investors, recapitalizing equity pools, option pools, to kind of, sort of top up our entrepreneurs, because it isn't, in some ways, it's not their fault that this market environment has happened. They're performing well. The fundamentals are amazing. That's the other hard part. You're crushing it on every KPI, on disbursements, on GMV, on take rate, on cost efficiency. Like, they're really building better businesses, and they're being rewarded with lower valuations. So that's hard also. So we also try to, as much as we can, cap tables are cap tables, but we are reestablishing ESOPs and giving our entrepreneurs a little bit more.
Yeah. And I think there's also still some required adjustments around growth expectations, right? In this new backdrop of expected kind of lower global growth going forwards. Difficult, as you're looking at obviously very optimistic entrepreneurs. But is that something that you've started to see kind of feed into business plans, people maybe having slightly more realistic expectations around growth rates? Sure.
I mean, I can give my 2 cents on that. I agree with Monica that this is the normal. The last few years were not normal. And I don't blame just the entrepreneurs. I think the founders and the investors themselves, and both, because they just don't have the proper timeline, historical timeline to know how these things are supposed to unfold and what VC economics are supposed to look like. And so there's a lot of background to this that we all grew up in. But it did seem like we had a lot of nouveau tourist investors pumping the founders up for a certain high growth rate. Now, I wouldn't say that this normal, which is the good normal, because it is supposed to be hard to get capital, and you're supposed to struggle. So that necessity drives innovation and capital efficiency, and without it, we saw what happened. So this is the better place for founders, and we speak every day telling founders why this is better for them. Now we have lots of cases to show them. Before, they were just had to believe us, and it's difficult because they think you're negotiating against them on price, and it really wasn't. And I think now, not only do we still require the high growth rate, but we never said, at least in my 26 years in the industry, no one ever told me grow at all costs. They told me use software to grow fast and have an outsized impact. And that's what was building software companies was. So today we still would say you still need to grow at 20-30% per month. But not at all costs, right? You still have to have the bottom line fundamentals in place before you start to scale. So the steps didn't change. And now we just need to go back to that reality and that normal state.
Yeah. And moving on from kind of more the mechanics and valuations to the themes, right? We've seen, obviously, in a low interest rate environment, a lot of business models that were possible around buy now, pay later, et cetera, that are now very much struggling. What do you think? I'll start with Monica. What do you think has changed there, and where are the themes that might prosper in this new environment that venture capitalists are going to be interested in?
Yeah, so it's a great question. I would say, if you look at our Fund 1, so Quona is a venture firm focused on fintech for inclusion. We are on Fund 3 right now deploying, and if you look at Fund 1, they had a lot of balance sheet businesses. So it was, I would call it 1.0 of fintech. So the early challenges, whether it's on lending to small businesses or secured financing, payments, like all the fundamentals, and basically there you're looking at what were fintechs doing in the West and how can we replicate that and modify it and adapt it to emerging markets. What we see now, especially as that first generation of payments, digital wallets have established, we're seeing a lot of infrastructure plays. So open banking, payment infrastructure, like the Plaids of the world, really beginning to connect either disparate players and being able to have some interoperability, allowing them to rebundle. So before you might have had a lending service, a fintech on one side and payments on the other, in challenger banking, integrating them so that you have really interesting synergies. Embedded finance, or that's use case finance, where the core business might be e-commerce or ag or even energy. We actually just did our first sort of electric vehicle investment in India, and this idea of actually using leasing to help make the battery more affordable. So just really creative ways that I would call them second generation fintechs that are really around use cases. And then for our case, because we're about inclusion, these are mass market solutions. So this is really helping ordinary, everyday people enjoy the benefits of some of the recovery, as limited as it is.
And Luis, from a Citi Ventures perspective?
Yeah, I'd, by the way, echo all of the ones that you've mentioned, and I'd be remiss without mentioning, some pretty exciting things we've seen in that space, such as within financial inclusion. We're talking earlier, one of our portfolio companies, PayJoy, in Mexico, their core market, but now becoming global within Latin America and in South Africa, entering India and other markets, effectively enabling individuals that cannot afford, that are underbanked and cannot afford the smartphone, to acquire one and pay it in installments, and in that way be able to participate in the digital economy. So explosive growth, very exciting company. And then another very interesting company we've been talking to, which we understand has entered, Dubai, started in Africa, Nigeria, Move, enabling, ride-hail, drivers to do revenue-based financing for the vehicles, and then selling on top of that a myriad of products, including on the payment side, on the lending side, for other things such as potentially a mortgage back home and things of the sort. So really exciting opportunities on the financial inclusion space. Other things that we've been seeing, I want to call out on the open finance that you mentioned, companies, like Plaid, a bit of a super exciting but earlier name from the US, Belvo, with a similar model within Latin America, and a lot of very exciting innovation in Europe within that overall space. And then the other one I wanted to call out is what we think within the wealth tech space, the democratization of access to investment products. And that ranges from products that are manufactured for retail investors, and unlimited funds is a great example of that, which is effectively a very early company that's seeking to replicate hedge fund returns and in an ETF wrapper, so available to anybody out of the US. And then another one, iCapital, which is a portfolio company, which is basically manufacturing feeder funds that are accessible at much lower ticket sizes to provide access to all types of alternative investments, hedge funds, private equity, credit funds, real estate funds, and the like, with smaller amounts that don't require ultra high net worth individuals. So I'll pause there for any others on your side, Sharif.
What themes are you focused on
within fintech? Yeah, so we have one of our two major pillars that we do our direct investing in is called Future of Finance. And we look at fintech, reg tech, legal tech, horizontal themes like financial inclusion and embedded finance, which is very interesting. But we had a couple aha moments over the last 12 months in that a lot of the buzzing fintechs you see are very scratching the surface of the entire stack of banking or any other subsector within fintech, and it's given us some pause on whether those business models will be sustainable over time. And I credit this to one of the founders in the audience I was speaking to, who was many years in banking, and he brought my attention to the 90% or so of the transactions and volume happening in banking are not happening on the front end. And a lot of this is happening on the back end, and most fintechs don't know enough about the financial industry to know what's happening on the back end. So all of this frenzy seems to be capturing only a very thin layer of the front end, and in certain categories within that, and I won't name just not to shame any particular group, but we notice that when you're just a user interface with a customer acquisition layer, and every other service behind you is outsourced to a vendor, you are chipping away at your margin in a way that it's very hard to see at first, but over time you reach basically margin erosion, and that's pretty scary because, as every other talk has said, fintech is the highest deal flow we've been seeing. Investor interest is highest in fintech, so I think we all need to be a little bit more careful and maybe educate ourselves more on what's happening under the surface, because I think that's where most of the volume and profits are. Another person, a friend here in one of the local banks, had told me that a lot of the deposits, the interest, the loans, even the bigger stuff that you might see on the consumer front end is not where the bank makes their money. And so that was very eye-opening for me to hear that is all just, that's all the noise we see on the front, but that's really, if they just did those lines of service, they wouldn't actually make money. So I think we all need to self-reflect and slow down a little bit and kind of look at that, because we're telling founders, we look at the bottom line and we look at the top line. Well, maybe we should all help understand that bottom line a little bit more.
But not just I will say that's the good part of this reckoning, right? I mean, I think if you look at a lot of those crazy high valuations, it was totally a customer acquisition and a nice app. Really. I mean, if you really look at unit economics and margins, that's the kind of quality that hopefully any dedicated fintech investor is siphoning through. So it's true, we have to all educate ourselves, but I think again, the nice way that this reckoning is also differentiating, real fintech investors from tourist fintech investors. Same thing in emerging markets. People who just come to visit who are really deeply rooted in these markets.
To pile on that, if I may, an interesting observation in terms of a big trend that I think is affecting across the board, and I think as a result of this shift a bit away from not being able to raise massive amounts and therefore not having as much to invest on direct-to-consumer model, it's the emergence of these more partnership-led models. Sometimes people will think about distribution that's B2B2X, and idea being of tapping entities that already have consumers. They may be financial institutions, or they may be any type of company in commerce in the broad economy that has existing consumers. And sometimes these are partnerships with banks, or they can be effectively enabling vertical solutions for other parties. In some cases, the company with the customer base may be on the front and the one that's driving the opportunity, being powered by somebody else. In other cases, it may be the startup that's doing it, and there is just either a win-win in the partnership or a revenue share or something of that nature. But basically, enabling that last mile access be achieved in a much more efficient manner as being far more important than the previous just direct digital acquisition models.
Yeah, I mean, that's great to hear. And, I feel slightly avenged because we've been focused only on B2B and enterprise technology for the last decade, which has been relatively underloved compared to a lot of the retail-facing things. And one of the pieces of information that we shared with a lot of our investors was actually, a lot of the investment was going into the retail-facing fintech, but actually most of the exits and realizations that were happening were on the B2B side. On that, I'd be interested to hear, because we see a lot of kind of copycat type business models happening in emerging markets in this region that had worked in the past in Europe and the US. Do you think we will see more of that here, or do you think we will see a kind of transition to maybe more B2B partnership type approaches from companies instead? I'll pass it to either of you.
I can start just from being on the inside here. Certainly 90% or so of the startups we've been seeing over the years are business model clones. And, coming from the US, that was something I had to learn to respect. And it happened quickly, but when you see Kareem being able to compete with Uber, when you see other incumbents who are able to localize and understand the local markets, we realize how important that is. And I hate to say, even Rocket Internet in the past that was doing a lot of market launches from Silicon Valley, that was very taboo because they're not the innovator in the tech. But we realize how important innovation in localization and execution becomes. So I think we're going to see this for a while, but one of the aims of our fund, and we're already starting to see, for example, the business model of B2B SaaS increasing over the last few years, but that requires the private sector adoption of B2B SaaS. So there's not a familiar thing just quite yet, but it's increasing for sure. I think a lot of sister entities and colleagues in other funds are trying to push the B2B envelope quite a bit. Trying to engage the private sector to be involved in that too.
Yeah, I'll say two things. One is we're kind of nerdy at Quona. We actually have always had 50% B2B. We love that. We definitely follow where exits are going. We follow where value is being created, and there's just the non-sexy, invisible stuff is where usually the most interesting things to mine. And that has continued consistently in our portfolio. But actually, what we've seen increasingly, because of course they're clones, the kind of copycats from the West to the emerging market with the appropriate tailoring, we actually see more, I would say, homegrown innovation. So one of that is because, for example, in Africa, mobile banking is so much more a proliferated part of the commonplace, where it's not, where the analogs in the US or Europe are much smaller. But even in some of the infrastructure plays, we're seeing, what I mentioned earlier, the kind of the company called Cherno in India, where they're leasing batteries and two-wheelers in general, which is not a phenomenon. Two-wheelers are a core part of transportation in many of our emerging markets. That's not really true in developed markets. So even how you finance that, how you go to market with that, I think there's some markets, models that are very specific to our emerging markets that are replicable south to south. So we do see some interesting synergies, even going from Asia, Indonesia to Brazil, for example. My colleague went from Jakarta to Sao Paulo last week doing some comparisons. So we actually see some really exciting comparisons south to south, which is taking over some of the west to east that we saw previously.
And Louis, in terms of Citi Ventures and Citi, you talked a little bit about like the partnership models and companies going down that go-to-market. Do you have an example or two that you might want to share with the audience around how that's worked well in the past?
Sure. I think that there's been a variety of examples. For example, one of our portfolio companies, Grab, the Asian rate hailing company, and then Super App partnered with Citi to launch a co-branded credit card. So that's an example of a pretty successful partnership there. We have partnered with others. Lots of examples are where we're a consumer of the product that the company has. A very successful portfolio company of ours, Secure, enables a myriad of identity verification, synthetic fraud, and the like products, which are very important when doing digital onboarding of consumers, where a lot of the flows have moved. We have also partnered with others in terms of using some of the products in our interaction with clients. There's a company called Comgo in the trade finance space, focused on energy and now working across industries, which is enabling trade finance digitization amongst banks and corporates. So there's been a number of pretty successful partnerships within the portfolio. Although within Citi Ventures, we always encourage them. Ultimately, partnership decisions are made by the business, and we act, as a bit of a catalyst, bringing the outside in and investing with autonomy in startups that are exciting. So in a way, we wear a bit of a dual hat as venture investors, but also champions of innovation within Citi.
Fantastic. We have just a couple of minutes left, and we have a panel of investors. So I figured we'd finish off on with some entrepreneurs in the room. What advice would you be giving to entrepreneurs today that are going out into the market fundraising? I've heard some very interesting things over the last few months. I personally actually think the pendulum maybe has swung a little bit too far in terms of hearing people saying, "Oh, you need to focus on profitability." It's like, yes, that's true if you're a Series B company onwards, but if you're if you're seed to Series A, it's probably still too early to be thinking about that. No? What would you say, Sharif?
You're absolutely right. We keep hearing those words, but I think nothing is qualified, right? You need to hear the rest of the paragraph. And I think that's where people got the grow at all costs thing from, because they just kind of heard a soundbite and didn't really get the whole story. What we tell people is focus on capital efficiency, build something before you raise, have some traction there, and focus on bottom line and top line while you're growing. Well, I think those are the fundamentals, and I think the new themes that had entered the fray now is institutionalization, governance, all of those kinds of things that you kind of ignored them as a young entrepreneur for the first few years until maybe Series A, and then you get a little bit of institutionalization, and then you build up from there. I think that's become a focal point now because there's just been too many things that have gone sideways that governments and even us as investors are starting to focus on those matters now.
That's great advice. And I would just to add, maybe or underscore, unit economics, not break even, is a big one. We focus on margin. How do you create defensibility so that margin is subject to compression? So I think that's a really important focus on us. The second would be on customer value and really understanding what's the customer journey. How do you make sure you're delighting them and really retaining them and really focusing on those KPIs? I think that will tell you a lot also about your sustainability. And third is, especially as a global fund, we always say, look at a new window, open a new door. I mean, we have a company called Hasna that's, actively starting in Egypt, looking abroad, and actually has had success, going to Saudi Arabia as well as the U.S. to find, new sources of capital. So when you're delivering on all your KPIs and a door closes on one of your funding windows, there's another one, just knock.
And my advice would be focusing on two things, talent and fundraising. On the talent side, I think you should be extremely choosy because there is such an abundance of talent, and there's been great talent that has been let go because of the situation, not because of performance. So absolutely look for the start team and don't settle. And then from a fundraising standpoint, a few things. One, raise more than what you think you need. Try to raise it from more investors. I think having a broader set of backers will really become important because you don't know what's going to happen next. And then, look to raise sooner than you think you'll need. So really brace yourself for what may continue to be a tough funding environment for the next several quarters, especially if you're at that earlier stage where you can't just rely on turning on profitability. And obviously the unit economics and all that will help you get there. But if you're early, make sure that you have enough runway.
Yeah, and if I can close out, you've had a panel of fintech investors here for the last 40 minutes, and no one's mentioned blockchain or AI. So forget the buzzwords. That's not going to help you raise. And with that, I'm going to thank all of the participants in the panel for spending the time here, DIFC and the organizers for putting together this fantastic event. Thank you
very much.
Thank you.